Hi guys, welcome back to the channel. It's Subsistence Traveling. I'm your host Jay, and today's topic will be stock analysis in 2020. I'm going to show you how the proper way to analyze stocks for now. Okay, now let's get right into it. Okay, because a lot of the ways that you guys are using are very misleading. So I'm going to show you how you have to evaluate stocks in 2020. All right, so here we have a look at the S&P 500. Um, it last closed at 2711. That was on Friday, this past Friday, up 9.29%. And just some key stats here. It's trading at what, 17.84. That's the PE ratio. And it's trading at 2.98, almost 3% on book, price to book. Okay, so just some statistics here on the S&P 500. Okay, so some common mistakes that I see are, after this correction, many people think that stocks are cheap, and I completely disagree. And that's because they're only using PE ratios. Okay, and I'm going to show you why that can be very misleading. Okay, and how, what to really look for. Okay, so I'm going to explain the PE ratios for those who don't really know. So to get the PE ratio is basically the stock price divided by the current earnings per share. Okay, so it's just a multiple of the current earnings per share or the forward earnings per share. All right, so the average PE for the S&P 500 is between 14 and 16. All right. The current PE is just under 18. Okay, so judging from where the S&P 500 is right now, there it would require a 20%, at least a 20% drop for it to reach fair value, and a 33 to 44% drop for it to be considered cheap. Okay. All right, so I'm going to explain how PE ratios can be misleading. Now, one of the trends over the past few years were stock buybacks. Stock buybacks reduce the amount of outstanding stock and increases the earnings per share. So when the earnings per share is increased, then that multiple seems lower. Okay. Now, another thing that can be misleading about earnings earnings aren't earnings predictions are not always accurate, especially with an unpredictable event like the coronavirus. Earnings are not a predictable measure. Okay, so right now I don't think the PE ratio is the only thing that people should be looking at. All right. All right, so we're gonna move on to book value, okay? And this is a little better way to, especially when you're looking for value, this is a good way of evaluating companies. Okay, so the book value shows if the value of a company if all the liabilities were paid off. Okay, so you calculate book value by taking the amount of assets and minusing the liabilities. Okay, so now a good metric to use would be the price to book ratio when you're evaluating stocks. Okay, and a lot of the websites don't really show the price to book ratio, but Bloomberg, I know Bloomberg definitely shows the price to book ratio. So that's where I get my information from. Okay, now the a price to book ratio of one or less is all is good. Anything above that is very overpriced or expensive. Okay, now you now just some information, okay? The S&P 500 is currently trading at almost 3 times book value. Okay? Now you calculate the price to book ratio by taking the number of outstanding shares and divide it by the book value. and that's how you get your price to book ratio. And like I said, the S&P 500 is currently trading at 3 times book value. Okay, that's pretty much the price to book ratio. And the thing is, we're currently in the midst of a debt crisis, so the price to book gives you a better idea on true valuation. Okay. Last but not least is cash flows, and I think this is gonna going forward. This is gonna be one of the more important ways of evaluating companies, in addition to other methods. But this is gonna become much more important. Okay. Now, it's very important in a debt-based world. It's used to analyze the solvency of a company. Okay. See, I commonly hear people talk about companies with good valuations and good balance sheets and good dividends. Okay. But these dividends, I don't think a lot of these dividends are safe. I think, especially with this crisis going on, many companies will have to, cut their dividends. Okay. And keep in mind, many companies borrow to pay their dividends, because it becomes a matter of reputation. And once those dividends are gone, investors are gone. Okay. So that's something, people must keep in mind. Okay. Now, like I said, it's used to analyze the solvency of a company. All right. Now, the statement of cash flows has 3 parts: operating activities, investing activities, and financing activities. Okay. All right. So I just wanted to show you quickly what a statement of cash flows look like. Okay. And I'm gonna explain to you the different sections of the statement. So the first part is the operating activities. This includes normal activities of business, like basically the sales of the business, just the normal things that the business do on a day-to-day basis. So sales, interest payments, taxes, interest or dividends received, just the normal activity of a business, whether cash is coming in, whether the activity brings cash in or the activity brings cash out. Okay. The next part is the investing activities. And this pretty much includes purchases and sales of assets, whether you're purchasing an asset or you're selling an asset. The money comes in or it goes out. Okay. The next part is the financing activities, and this includes mostly financial matters, includes dividends paid, stock buybacks, bond issuances. If it brings money in, it's positive cash flow. If it brings money out, it's negative. Okay, so that's the financing activities. Okay. Now, these are my thoughts here. These are my thoughts. All right, so my final thoughts are: there are plenty of opportunities in the markets, but you must use caution. Okay, I think these markets have more room to go lower. After analyzing many companies with good balance sheets and dividends, I realized that most only make enough cash to pay dividends and pay debt. So an event like the coronavirus will definitely jeopardize dividends. Okay, many companies may have to reduce or cut dividends. All right. My advice would be to dollar cost average down. Consider preferred ETFs. They're in an environment like this, preferred shares, especially if you can find one excluding financials, would be perfect. I think those dividends would be a little bit safer. And also, you want to consider international markets with yields and low debt. All right, so guys, thanks for watching the video. I hope that you subscribe to the channel, like, share, and comment on the videos. I like to hear what you think. And again, peace to all.